Warren Buffett once said, "The key to investing is determining the competitive advantage of any given company and, above all, the durability of that advantage. The products or services that have wide, sustainable moats around them are the ones that deliver rewards to investors." This philosophy helped Buffett deliver a 20% annualized return since 1965 when he took control of Berkshire Hathaway, generating over a 4 million percentage return. Since 1956, Warren Buffett has been writing about his process for finding exceptional investments. In his annual shareholder letters, Buffett identifies 4 unique competitive advantages that can help you find compelling investments. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. In this video, we are going to walk through the 4 different types of competitive advantages, what it means, how you can identify these types of competitive advantages in individual companies, and one of my top holdings that I believe has all 4 of these types of competitive advantages. If you enjoy educational investment content, please make a point of hitting this subscribe button, hit that like button, and let's dive right in. So what are the 4 types of competitive advantages? The 4 competitive advantages are as follows. Number 1, a cost advantage. Number 2, intangible assets. Number 3, switching costs. And number 4, network effect. A cost advantage is when you have either a leaner price structure or enough scale that you can operate at prices that competitors can't match. One of the first examples of this type of cost advantage was with John D. Rockefeller's Standard Oil. A more recent example is Costco, which uses their high volume and wholesale membership model to get supplier prices that can't be beat. The second competitive advantage is from intangible assets. This is when a company has a brand or patent that keeps customers loyal and prevents competitors from taking market share. Another way to think about a brand is that it helps consumers shortcut their decision-making process. Why risk paying less for an unknown product or experience when a trusted brand instantly promises consistent quality? In other cases, the brand signals your values, net worth, or social standing. The third competitive advantage is from switching costs. This comes when a customer is locked in and can't easily switch to alternative and possibly better competitor solutions. One example of a switching cost is with cloud infrastructure providers. If your company already uploaded all of their information to Amazon Web Services, or you keep all your family photos on Apple's iCloud, are you really going to switch to another solution? The fourth competitive advantage, and one of the most powerful, is from network effects. This occurs when a product or service becomes more valuable as more people use it. Classic examples are Amazon, eBay, and Facebook. So why is a competitive advantage important? For developing markets, a competitive advantage means that you can take market share and grow faster than your competitors. For proven or developed markets, a competitive advantage ensures a stable position and should translate into high profit margins, lots of free cash flow, and a compelling return on equity. Historically, Warren Buffett has focused on these types of companies with proven market structures, stable competitive positions, and compelling profitability. That said, many investors have also done very well with businesses with a less developed market position but clear signs of building competitive advantages. Now I'm going to share one of my top positions that is currently building a moat with each of the 4 key competitive advantages. First of all, though, keep in mind none of this is financial advice. Also, recently, Michael, a premium member of the exclusive Unrivaled Investing community, shared, "So far this subscription has paid for itself in 3 months. Looking forward to what the future holds." He's talking about Unrivaled Investing, and prices are going up soon, so now's the time to lock it in. Before sharing one of my top positions that's working with all 4 competitive advantages, it's important to remember building a moat is to help either drive sustainable outsized free cash flow or the ability to rapidly take market share. These different goals depend on the market, whether it's developing or more established. One of my top holdings is C Limited, ticker symbol SE. They own Shopee, the #1 e-commerce marketplace in several Southeast Asian countries like Indonesia, Thailand, and Vietnam. By having the largest e-commerce marketplace in their regions, they benefit from a double-sided network effect where more shoppers attract more sellers, which ultimately brings more shoppers, and so on. Attracting more merchants to their platform helps ensure that they have the lowest pricing available for customers, driving a cost advantage. They also have a strong brand that signals to customers a repeatable and consistent experience they can trust, but also signals to other brands that they can do partnerships that helps drive their growth. For example, recently YouTube announced a partnership with Shopee. Lastly, their customers and merchants have a switching cost. Why buy from another platform if you're not sure about the reliability? Or if you're a merchant, why take the efforts to market on another platform when the Shopee platform already has the bulk of your business? So let's do a quick summary. Warren Buffett has identified competitive advantages as the key to successful investing. That's because competitive advantages are like a moat around a castle, protecting it from competitors. For developing companies, those competitive advantages can translate into outsized revenue growth and capturing market share. For more developed markets, for more developed companies, it's more about ensuring that you have a stable business and that competitors can't quickly steal your market, can't quickly steal your profits. So for those types of businesses, that's typically what Warren Buffett has been more focused on. It's about very high profit margins or significant free cash flow and very high return on equity. So when you're seeing either sales growth that's significantly outpacing the competitors, or you're seeing very high return on equity and lots of free cash flow, that might be an indicator that you're looking at a company with significant competitive advantages worth digging further. The 4 different types of competitive advantages are a cost advantage, intangible assets, a network effect, and switching cost. So those are the 4 different types that might drive some of these financial outcomes that we were just talking about. I personally used this knowledge of competitive advantages when I saw C Limited stock sell off, and I thought, wow, Shopee has all 4 of these, and that's why I called it out to my subscribers at Unrivaled Investing, around $40 per share, saying, hey, I think it has all 4 of these, so their Shopee platform could recover over time. If this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.